Look at the latest US GDP numbers, and you will see a steep drop-off in economic growth. The Federal Reserve has spent the last few years aggressively manipulating interest rates. Combine that tight monetary policy with a strong dollar and intense geopolitical conflicts, and you have a global economy where minor shocks trigger systemic failures. Financial forecasts for 2026 point to a severe contraction. We are currently staring down a 40% probability of a major recession, with analysts asking whether a market crash is a question of timing rather than if it will happen at all. The central banks know exactly how precarious this is. Federal Reserve Chairman Jerome Powell recently expressed deep concerns about the nation's balance sheet. The bill for trillions of dollars in printed pandemic stimulus money is due right now. When an economic downturn of this severity hits, a massive amount of wealth disappears. Incomes drop, and everyday assets, the stock market, your real estate, and corporate bonds become vulnerable to a sudden collapse. It is tempting to panic, sell everything at a loss, and stop investing entirely. But retreating from the market during a downturn guarantees you will miss the eventual recovery. There is a counterintuitive reality to how money actually works. Severe bear markets and deep economic contractions offer the most significant buying opportunities of your life. Take the legendary Wall Street investor Shelby Cullen Davis. During a 40-year career filled with extreme market volatility and severe recessions, he started with just a $50,000 loan from his father-in-law. By the end of his career, he had turned that initial capital into a $9 billion fortune. You might not hear his name as often, but Davis's returns were comparable to, and in some metrics even better than, Warren Buffett's. He built that empire by knowing exactly what to do when everyone else was too terrified to invest. To replicate his success, you cannot approach a volatile market with a gambler's mindset. You have to abandon the panic, retain your financial strength, and learn the predictable, mechanical anatomy of an economic crash. This diagram illustrates how the economic cycle operates. We start at the peak, an era of massive expansion where surplus money drives up consumer spending. To fight the resulting inflation, the central bank steps in with tight monetary policy, hiking interest rates to slam on the brakes. Doing business suddenly becomes difficult. Corporate profits drop, companies freeze hiring, cut bonuses, and resort to mass layoffs. With fewer people employed, consumer spending falls even further, creating a vicious downward spiral for the entire economy. If governments do not intervene, this downward spiral ends in widespread business closures and bank failures. We saw exactly how catastrophic that can be during the 1929 Great Depression, when free market policies failed to correct the panic. Cash serves as a temporary typhoon shelter during this freefall phase. Use it to preserve your purchasing power while waiting for the cycle to bottom out. The most common mistake retail investors make is trying to catch a falling knife. They see initial price drops, assume the asset is cheap, and buy in long before the market stabilizes. Even a dominant company is a poor investment if you buy at the wrong time. Take a powerhouse like Nvidia. If you bought in right before a previous market correction at over $300 a share, you watched your portfolio lose 2/3 of its value before it finally recovered. You have to wait for the turning point. You are looking for the moment of maximum pessimism. This is the exact hour when public despair peaks, corporate earnings look terrible, and central banks are finally forced to step in with rate cuts and stimulus packages. The timing of your entry determines your ultimate return far more than the specific asset you choose to buy. When asset prices remain low despite favorable government policies, you have found the golden hour. Once that turning point hits, conservative investors should start with secure national debt. If you buy US Treasuries when the economy is at its worst, interest rates will be at their peak. When the central bank inevitably cuts rates to save the economy, the face value of those bonds will skyrocket, giving you both high interest and capital gains. But if you want to aggressively multiply your wealth, you hunt for high-quality tech monopolies. Recessions freeze the capital markets. Weak competitors are starved of cash and die off, while strong companies outlast the winter, consolidate power, and build impenetrable economic moats. This graph illustrates the mechanic behind the famous Davis double play. Once the economy stabilizes, these surviving monopolies generate massive profits, sending their earnings per share up. Simultaneously, a recovering market drives their valuation multiple up. When both metrics rise at exactly the same time, it creates a 10x multiplier effect on the stock price. We have seen this happen repeatedly. Companies like Alibaba survived the dot-com crash in 2000 while their competitors ran out of cash. Tech giants dominated after the 2008 financial tsunami. These companies brought generational wealth to the investors who bought them at peak pessimism. But picking the right stocks is not a random lottery. You need strict frameworks and detailed financial education to identify these resilient monopolies before the rest of the market recovers. That is why I created a comprehensive program to teach you these frameworks. Click the link in the description below to join the SFA Free Stock Investment Masterclass. When you are in the middle of a crash, the public will try to convince you that the financial system is permanently broken. They will insist that the geopolitical landscape has changed and that this time is different. Sir John Templeton warned that "this time is different" are the four most dangerous words in investing. He taught that bull markets are always born on pessimism. The mechanics of human fear and economic cycles remain remarkably consistent. Back in 2003, amidst intense economic fear, the public thought the property market was completely hopeless. I took a calculated chance and invested $500,000 of my own capital into prime real estate. By continually reinvesting my returns, that portfolio grew to over $100 million in a single decade. An economic recession functions as a mechanical transfer of wealth. It moves capital from the panicked masses into the hands of the educated few who understand how cycles actually work. Do not let fear dictate your financial future. If you found this breakdown helpful, make sure you hit the subscribe button. I will be sharing my 3 decades of investment experience to help you navigate this crash and find those 10x returns. This is Stewardship Finance Academy. Stay sharp, and I will see you in the next one.